Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
G'day, how you going? Phil Tarrant, co-host of the Pure Property Podcast with Paul Glossop. It was certainly pure the commentary on this podcast.
I never know where you're going to go with these introductions.
No, how you going? Paul Glossop, you well?
I'm good, mate. I'm good. Back at it. Flying through.
Yeah.
Already
So
February.
you're looking very casual. Looks like you've just come off a beach in Mykonos with the three buttons unbuttoned there. Is that
showing
the look?
off the summer tan?
Is that it?
I got a rack. I got a shirt off your rack and thought, well, this is as good as it can get.
Is that like the cross between linen and Egyptian cotton?
It's Dylan. A cross between denim and linen.
It does look like denim and linen.
Yeah.
But, I don't know if it
I've got the shorts to match.
If it works.
I wear them when I head over to Tasmania.
Yeah, when are you going to Tasmania?
When I'm prepared to put on my tuxedo.
You're not buying a Tasmania at the moment.
I'm not. Some are, though. It's starting to get a bit of traction. I saw John McGrath was putting it on his list of places to watch for this year when he puts out his annual report. Not on my report. It was on our report back in 2015, 2016, 2017.
Yeah, some time ago.
A long time ago.
Nearly a decade ago.
We did all right. That makes me sad.
It's crazy.
Thinking that I was
still
traveling
think about
there.
2015 going, oh, yeah, it's only just a couple of years ago. No, it's a decade ago.
No, you had children who weren't born then.
Yeah, it's crazy. 2015. What was going on back then? I can't even remember.
Yeah. Interest rates were about the same.
Yeah.
Yeah.
And this is the point. Everyone's sort of talking about the cost of living crisis and all these type of things and interest rates. And, I remember when I think it was back in May of 2021. Is that correct? Was when 2022.
They started to go up.
22, yeah, that was when
correct.
the last federal election was.
Yep.
And I think it was the election was in May and the first hike was in May. And from what I remember of those times, which is so long ago right now, was that the government that came in, so the Labor government, usurped the coalition government on the basis of promising lower interest rates and lower energy prices.
Lo and behold.
So it was 0.1% was the official cash rate. People's mortgages
Good luck with lowering that.
People were on like 1.7% mortgages.
Locked in for
fixed.
3 years.
Even variables were like 2.5, I think.
Yeah.
And
the good old days.
And we were told back then that a new government would give us cheaper mortgages and cheaper electricity. Yeah. So anyway, go figure. We're about to enter a new election cycle.
Absolutely.
Soon, so
and you'll see all the promises. I know the Greens electorates out in Melbourne, their heartlands there. There's some promises of we'll get some rents capped and fixed rentals and all this. I'm like, well, it appeals to people who want to hear that noise. But will that happen?
Whatever appeals. I think what I hope happens irrespective of who goes into power in Australia, or whether the government retains power. Less red tape, not more red tape. Less rules governing how markets operate rather than more rules governing how markets operate. Let's talk about rental markets for a moment. Makes a lot of sense to try and make it even more onerous for property investors. To hold property through new rules. I saw a rule coming out the other day. I don't know about this. 31st of March, 2025. If you're in New South Wales, if your dunny isn't a dual flush dunny and it hasn't got a 3+ something star rating on it, you can't charge your tenant for water anymore.
Amazing.
Like.
Can you buy him a bucket to sit next to the dunny and just
buy him 2 buckets?
Two buckets.
There you go, 2 buckets. It's manual.
One flush or half full?
Half flush, full flush. One small bucket, large bucket. See, that's sensible. I wonder if that would carry.
No, yeah. See, this is it. Then it incurs manual labour, and then we get charged for that, and there's some insurance problems.
Insurance
my back.
I've done my back because I had
my
to.
back.
But the point, we'd laugh about it, but it's just another. How specific do they want to make a rule? Talking about red tape.
Oh man.
For a property owner goes, mate, it's a flushing toilet. Just hold it down a little bit, and so a little bit of water comes out.
Yeah.
Or if it's yellow, let it mellow.
What happens if you ever have to let it mellow and it's a week later and it's becoming a bit more browny, stodgy?
Just give it a little half flush. Just a little half flush.
Okay.
Mate, half flush. But we laugh about it.
Toilet humour.
Yeah, but this idea around how about less rules and regulations? Like deregulation can go a long way. Yes, we need regulation. Certain things need to be regulated, but you only need to look in financial services. Over-regulation in financial services, mainly wealth management, means that less Australians now use a financial advisor because they can't afford it, because it's nearly impossible to operate as a financial advisor because there's so many rules. Decimated the industry.
This is a capitalist in you coming out here.
That's
Philip.
true.
And I fully subscribe. And I think
we police for the fringes and the bad people.
And then all of a sudden it's doing a huge wedge of the population a disservice because they can't access actual financial advice. And majority of financial advisors out there were decent providers of advice. Yeah. And all of a sudden now it's become too expensive, too onerous, too time consuming, and no one takes it on. So therefore, people will go and do it themselves. Now, like you said, the property space is a massive DIY space. And for the most part, people get it right. But when you take away the ability for the people to actually just go and earn a crust and not expect an email or a phone call from their property manager because their 3-star rating is out of loop with their property. Now, look, a lot of property owners, investors, yourself and me included, Phil, always, I feel like every week I'm updating a property in some way, shape or form. I'm upgrading a safety switch. I'm upgrading water. I'm doing something to advance some sort of efficiency and obviously make it safe. That's par for the course. But forcing it on you to say you have to do this at this time, otherwise you can't charge. I mean,
look, we've got to remember, property investors, they're in the business of providing residential. They're a residential accommodation provider. That's their job.
That's it.
That's your business, rental accommodation provider. And therefore, you need to provide rental accommodation, which is safe and secure and all that sort of stuff. Yep. And we need to ensure there's common standards relating to that. Fine. Let's say in the past, maybe, some rental accommodation providers probably weren't keeping their houses up to standards. So I like to expect there is a standard.
Yep.
That's okay. But manipulating markets through what you spoke about there, trying to put rent caps. You can't cap mortgages, and I want to talk about mortgages today and interest rates, but you can't intervene on one side of the balance sheet. That is
without an equal and opposite reaction to the other side.
Accountants, they account on both sides. The cost there's an expense there, right? You can't say with property investment, we're going to cap rents over here without saying we're going to cap mortgages. Like you would think, well, they would go together, and no one's ever going to cap mortgages because I say it's the cost of doing business. That's where the money markets are, whatever. So you can't do one in isolation and the other. And I think it would be idiocy to try and regulate the capping of mortgages for property investors or owner occupiers. So leave the other side alone.
But and you only have to look at Brisbane, a couple of years ago when they looked to impose their land tax but you look at the direct outcome of that, where the Brisbane government at the time looked to impose a flat land tax irrespective of whether Queensland government looked to impose a flat land tax for anyone who owned property in Queensland but also elsewhere, and essentially pull it together to say that is your land value, assessable land tax value. Now, thankfully, I know you did a lot of work on that, Phil. We were very vocal for a long period of time. During my time at Pippa, I was on that voice piece for a long time, and thankfully that essentially got rescinded. However, we saw the outcome of that. There was 4, 5, 6 months of investors sold en masse.
But the only reason why, and we got stuck into it, and I'd like to think that we helped educate people around it. But the main reason why the Queensland government pulled back, and we have a different government up there now, surprise. Yep. Was because every other state premier or the heads of the territories went, "You're an idiot." Like they pretty much said, "You're an idiot. You can't do that." In colloquial sense. And they went, "Okay, we'll rescind it." But and we should do a podcast at some time. The top 5 pieces of legislation or regulation that they tried to put in that didn't work. That would be easily a top.
That'd be top 5.
That'd
be a top 5. And the outcome, though, I mean, this is what it comes down to, is that even though it didn't get gazetted and essentially made in rule or law, but what happened was that those people who sold for that prior 6 months, and I've fielded no shortage of phone calls, and I know firsthand people who actually sold property, so do you, because they expected this was actually already a done deal. And their intention was that we want to make rents more affordable and property more affordable. But back to your point, private property investors are there to provide accommodation for renters who can't afford to buy a house or who want to rent in a location which they may not be able to afford or just want to rent full stop.
Yeah.
The rental pool shrunk because investments in the rental space dried up because investors sold to owner-occupiers. That was coupled with more demand than there ever had been in the Southeast Queensland market. And lo and behold, here we are in 2025. The prices of property 3 years later are now about 50% above what they were then anyway.
And I'm super surprised with how Queensland has continued to motor along. It's sort of, growth is slower, but it's still motoring along.
Absolutely.
But this comes back to this philosophy, and I note, and I don't want this. Look, we're entering an election cycle, so we're going to be talking about this a lot moving forward. And I don't want to talk about property too much through the lens of who's in power, but I do note that this election is going to be won or lost largely on housing policy, and it's probably the common thread that binds all Australians, right? But And I acknowledge it's bloody tough to get right.
Yep.
Like there's so many moving parts to it. It covers everything from development to livability to advancement to all this sort of stuff, right? But you can't make property decisions around regulation in isolation. Everything has consequences and bubbles. And to pick up a point you said there, people sold a whole bunch of investment properties on the pretense that it was going to be too expensive to hold, so therefore they were looking to liquidate, deploy that money in markets where they got more certainty, right? So there would be one side, you talk about balancing the books, there'd be a whole bunch of people saying, isn't that great? We've finally won. We've got rid of property investors. Now more first-home buyers can enter the market. Everyone wins, right? And there is a case and a cause for that. There would be one consequence. On the other side, the ledger is, there's no more rental accommodation. I can't get a rental accommodation. I go to an open home. There's 50 people there. I never get one. I can't live anywhere. I've got to live in my car and all that sort of stuff. So, no matter what you do, it's every action has an equal and opposite reaction, and that certainly happens inside of real estate. So what we need to be careful about, and this goes back to the point to our political leaders, we acknowledge it's hard to get right, but you've got to legislate for the masses largely, and where you're on the fringes of where it gets tough, the obligation is on the government, I think, to sometimes put their hand in their pocket. What I'm talking about there is affordable housing and getting people in housing commission houses. It's ridiculous the wait list for that sort of stuff, right? Concentrate on that. That's your obligation, I would say, as a government. Get people in housing. When they're not generalising, there's a lot of rorts going on at NDIS, but there's a lot of people that require NDIS housing. Operate and concentrate on that. Operate on ensuring there's enough housing, commission housing or affordable housing for people that need it, and just let the market get on with it. Don't over-regulate it because you're regulating it for the fringes, and it's wrong. And what I want to talk about today is highly connected with this, Paul. We're going to enter a new market moving forward, and whether it's going to be this month, in 2 weeks, or it's only about 4 days away now, the interest rate announcement, or it's going to happen in May. Who knows? Jury's still out. I think the mail is that we're going to get a cut in a few days' time. It's going to change the market again. So good luck with that if you're going to try and regulate for it, because things are going to change. So I want to pick your brains on that and get some sense of what we can expect in a downwards rate market. Now, a downwards rate market's got to start somewhere and end somewhere. I think we know when it's going to start. We don't know where it's going to end. Yep. So let's talk about the next few days. So was it 4 or 5 days, I think now, on Tuesday, we get
the 18th.
An interest rate announcement, and every single bank now is saying there's going to be a cut. And I spoke to someone the other day who is quite senior, who had some conversations with very senior people in government, and they pretty much said there's going to be a cut. Yep. So, which is, we've been musing about this late last year when the cut would come. It was February, it was May. Will there be any cuts at all?
And there's so many moving parts.
There's so many moving parts.
You look at the election over in the US and the outcome of that, and even in the last few weeks, these discussions on what these tariffs are actually going to mean, and all of a sudden, the last few days, you see the massive sweeping changes to 30-day pauses on tariffs. And I mean, the outcomes of these things, if imposed, could be enormous, right? And I mean, you'd be mad to make predictions as to where the money market's going to be in 2 years, because there are a lot of things which can influence it up, down, sideways. And I think that's that's going to be true. However, the immediate cuts more or less going to be a given now.
Yeah,
I think, and I think that being said, like you said, is well, what happens?
What happens now? What happens? Sort of what's the tail of what happens? So what happens immediately? And look, there's a piece of me that still goes. There's still 20% of me that still goes. Maybe they won't cut it because of these unknowns, right?
Yeah.
There's unknown unknowns, but these unknowns, particularly around what's happening in America and ramifications on trade tariffs to our trading partners, specifically China. How's that going to shape spending habits and investment? You've got to dig deep into the numbers, and you've got the government will tell you there's been the economy's in good health. There's all this jobs growth, and also you pick into that. Most of the growth that's been taking place in Australia, albeit slow growth on comparative years, has been the government spending money to stimulate jobs. So, 90% of all jobs created are in sort of non-market sectors, which is like areas that that taxpayers usually pay for, right?
Yeah.
So stuff connected with government spending is where all the growth has been in terms of jobs. Big question mark around that. What does it mean? You get a change of government, things are going to change very, very quickly. So there's still 20% of me that's got the Reserve Bank sitting there, and they'll debate it pretty hard. And I reckon no matter what happens, it's going to be a line ball decision. They come out and say, we've cut it, but it was really, really close, and these are the reasons why. You'll see it in the notes. Or it's going to be, we went so close to cutting it, but this concerns us, this concerns us, and this concerns us. So maybe 20%.
Maybe. Let's make an assumption, because by the time everyone's listening to this podcast, it's probably going to be either the decision's already been handed down or it'll just about to be handed down. So I think
let's assume it's cut.
So let's assume we go from a base rate of 4.35 to 4.1, and let's assume it's a 0.25 cut.
See, they might even just cut by 10 basis points, right?
They might.
Just it'd be nice to line it all up so it's 4.25. Like, not a lot of people talking about this. They talk about, are they going to cut or not? Like, here's something a bit topical. Maybe they'll just cut by 10 basis points.
Maybe they'll cut by 0.5. Maybe they just really throw it out there and do one big cut for the year and say, let's give it a crack and see what happens.
Happy days.
And then the government will be doing backflips because all of a sudden that leads into their election promises, etc. But let's assume it's 0.25 and it goes with what the long-term traditional cut rates are or interest rate rises are. For the numbers for everyone listening, what does that actually mean for your mortgage that you might hold today? For $1 million out the door, lowering it by 0.25 is about $2,500 a year in reduction in interest repayments. Now, that's after tax money. That's probably $3,500 for most people, maybe somewhere there or around about $3,500 to $4,000 gross that they would otherwise have to earn. For a lot of people, if you're on $100,000 a year, that's essentially an annual pay rise. That's about in line with your 3-ish% increase in annual income. So that's a significant amount of money. That being said, realistically, is that going to then influence and impact people to be able to do more or want to do more with property? Well, that's the part which it's a double-edged sword. For those who haven't got debt and maybe were maxing out at a certain amount, we've also got to remember that for every cut, there is an increase in borrowing capacity. Now, obviously, it depends on what you earn as to what the cuts are going to then dictate to what you can borrow more. But the reality is, when you get a rate cut, your borrowing capacity increases. So if you're sitting on the fringes thinking, I can't afford to buy that property, well, all of a sudden now, if you're sitting at $500,000 maybe maxed out and you want to get in at 550, 600, one interest rate cut will basically get you there if you're already qualifying for a $500,000 pre-approval, but you think that's not quite enough to get you where you want to get to. This is what tips you up to that extra $50,000 to get you into that market.
It's a really good point, and this is a podcast for property investors. So the dialogue that we'll have is probably different than what you would hear elsewhere. So what you're doing there is framing an interest rate cut in the context of what does that really mean for a property investor, and that's not, hey, congratulations, your interest might be a little bit cheaper. What you're saying is that, hey, this is going to give you more borrowing capacity. It's going to change your serviceability position. So on that basis, you can either refinance to something that's not working for you and leverage out the equity on it, and or it's going to give you greater serviceability to qualify for another loan or more loans. And that will be the cascading point of this moving forward. Correct. As interest rates come down, for the property investor, it's going to amplify your ability to take greater proactive control over the journey as a property investor.
Exactly, mate. And that is it. For everyone who's listening here now is that as and when this decision's passed on, and let's assume that it's passed on. Let's assume you're listening to this and like, okay, I'm sitting there right now. Either you're a property investor with exposure to the market or you're thinking about it. There is no shortage of people over the last 2 years in particular when we've gone from the rate cut or the rate interest rise cycle of May 2022 to where we've basically been a year later to now being in this sideways movement at 4.35%. This huge increase that
we've been at that for a year now. So every Aussie's largely held that interest rate for a year.
You've held it for a year, and you've probably also seen that your previous really, really sharp rate over the last couple of years, if you were fixed, it might have reverted back to what this current rate is now. And obviously your increase in income, your increase in expenses, decrease in income has no doubt been fully affected. This is the time where your mortgage broker or a very savvy investment-focused broker is the one who's going to be the enabler initially, because you need to speak to them to say, what happens now? What is possible now? Is it possible for me to refinance? Is it possible to refinance and extract equity? If you're a first-time investor and you were sitting on the sidelines, even if you were able to buy and you thought, you know what, I just want to wait because I want to see what happens. Well, what happens historically over 30 years is that property prices increase in line with interest rates decreasing. So that's the other big one here is that if you're a sideline sitter, you need to really consider when is the time that you're going to strike. Because if you're not going to strike in these moments, expect that you're probably not going to do much at all.
And it's this intersection between mindset and your ability to the mechanics of being an investor. And we'll talk about them separately, but I agree with you. They're absolutely intrinsically linked. So let's just sit on this immediacy of if there is, we're assuming there's a rate cut in a couple of days' time. So what happens immediately? Well, your serviceability equation changes. But this is on the assumption. There's one major assumption that we need to talk about, and that is that lenders
pass it on.
Yeah, and it's going to cascade into a whole bunch of. So we're going to park mindset, but let's talk about the mechanics first. So that cascades probably into 3 or 4 sub discussions, right? So, and you should really get a flow chart out. I should really get a whiteboard and do it for our listeners. This happens, this happens, this happens, and this is how you got to think about it. Don't do it, but there is an official change to the cash rate. Do banks pass it on? Yes or no? Okay, let's say no. Okay, let's deal with no first. So there's been a cut to official cash rate, but your lender hasn't changed your interest rate at all. Okay, what's your choices? Do nothing or do something. Okay, you want to do something about it. The first thing you would do would be get on the phone and say, Mr. or Mrs. Banker.
You bastard.
Mr. or Mrs. Banker, can you please pass on the interest rate cut, please? Now, there's 2 things that's going to happen with that. They're going to go yes or no. If they say yes, you need to be armed, ready going, well, I know that I spoke to my broker and my broker told me that if I go with this lender over here, I can get, 6.2% and you're charging me 6.55%.
Yep.
And they go, okay, tell me about that. And they'll put some numbers in the machine. You hear some typing. They go, yes, we're happy to provide you that rate. Okay.
Congratulations.
Mr. Tarrant. You've
been
right.
approved.
Then they'll say, look, this will come in effect in 15 days' time. So they'll gouge you for another 15 days.
That's a given.
And then you've got to remember to check your statement, check your online banking, they actually pass it on because, surprise, surprise, sometimes they forget, right?
I forgot to hit that button there.
Forgot that. Yeah. So you think there's 4 or 5 steps there. That's like, that's no yes, yes,
sound like someone who's been through this before a few times.
Many times, right? But if they say no, right, then you've got other decisions to make. This starts a whole another side of things, right? Which is you need to get a new mortgage because you're not happy with the one that you have. And the new mortgage being either I want it because I want cheaper repayments because I just want cheaper repayments because I want to buy more smokes and grog or fuel money, or I actually want to leverage and because I've got greater serviceability now, I want to keep investing. So then you get to speak to your mortgage broker and you got to start a process to get a new home loan.
Yeah, be prepared.
Be prepared.
And be prepared to do a little bit of work.
A little bit of work. And I would sit there and I'd map it out and be ready for it because there's lots of choose your own adventure with it.
Massively.
And there's going to be points where you just go, what did you say? On $1 million, it's
$2,500
So
cash after tax.
Cash money. Yeah. So, what was it? 100 and something bucks a month? Is that correct? Yeah. So you go
$100 a week.
So $100 a month.
A week.
A week, sorry.
A week.
100 some bucks a week. Could I really be bothered? Do I just suck it up? And you know what? Within banks, there's a thing they'll be sitting there going, it's probably about 30 or 40% of people that, number one, won't know about it, and number two, won't do anything about it. So they go, yeah, all right, just leave it. Loyalty tax, right. So this is what happens come a few days' time and rates cut.
Yeah. And this is it. This is the mindset part, is that for most of us, if you're sitting there and, whether it's $100 a week, $50 a week for a $500,000 mortgage, or if you're a larger scale property investor, it could be multi-millions in debt. You're talking, for most of us, for the average person, to $100 a week.
It's $100 a month. It's $2,500 a year.
Sorry. No, it's $100. Yeah, it's $2,500 a year. Sorry, not a month, a fortnight. Fortnight.
Yeah.
Good math here.
Yeah, good.
We got there eventually.
We work in numbers.
Yeah, absolutely. But the reality is, if you say, look, every week, would you walk 10 minutes out of your way to pick a $100 note up off the sidewalk? If I was going on my lunchtime walk, and I knew there was going to be $100 sitting in the same spot every single week, would I do it? Yeah. The answer is yes, I would. And even if I didn't need it, out of spite for it being in the bank account of one of our banks, as opposed to mine, I'd probably want to do it then too. But the reality is, we're talking massive enabling opportunities here. But the flip side to this, which I think is the so what happens if I were to take action or not take action? What happens to the asset value? And for me, that's the bigger dollar change. Because, saving $1,000 or $2,000 a year here or there, yes, it's not chump change. No one's going to walk over a couple of grand in the street for that being accessible to them for maybe 20, 30 minutes of work and a bit of paperwork to follow that up. That's probably the cheapest couple of grand you'll ever earn. However, that being said, it's like, well, if you're one of those people who are thinking, I'm thinking about refinancing my principal place of residence, getting my first investment loan set up and taking some equity out, and I need to go through that small amount of pain to enable it, and I'll save a bit of money by refinancing my home debt to do so. Let's assume it's $2,500 a year out of $1 million debt. What happens when interest rates cut? What happens to property prices over the forthcoming term when rates are cut? And that, for me, is where the massive...
That's what you're worried about.
This is what I worry about, is people not taking action. Is you're like, well, even if you're not concerned about saving some money here, asset values appreciate in times of rates decreasing. That's the brass
So
tacks.
there's actual numbers and evidence around that.
Absolutely. And it's consistent, not even just in Australia. If you look globally at interest rate decrease cycles, it is hands down every single time. And it averages out, I know we're talking about this off air, it averages out for every 1% decrease until the rates moderate and also increase. Between that cycle, for every 1%. Peak to trough, it typically is somewhere between... depending which way on it you are.
Yeah.
But I mean, it actually doesn't work for the increase cycle. It actually works not as conversely to that. So you'd think property prices decrease in those times. They actually don't. Mm-hmm. They certainly do increase when rates come down, though. They increase anywhere between 10 and 20% on average. Now, obviously, there's variances depending on the markets and property types, but 10 to 20% for every 1%. So if we sort of look at what
10
happened,
to 20%
increase for every 1% decrease in rates.
So there might be, it might take
2 years.
2 years.
2 years.
For that 1% to play out.
Yeah, exactly.
So over that 2 year period, there'll be a 10%.
10%. I would say decade minimum. Now, put that in perspective.
That smells about right anyway, right?
This is it.
People go 10% in 2 years, that's crazy.
And it might just be a bit of a confirmation bias, because that might not actually be the reason why property prices increase. But if you look between 2004 and 2024 in Australia, and you average out our house price growth, average house price, strip out units, apartments, etc., but just look at purely house price growth, the average is about 6.1% compounded average annual capital growth, excluding yield. So 6.1%. The lowest in that time was minus 6.2%, give or take. That was an accumulative, every single property that transacted. What year do you reckon that was, Phil? Just out of question off the top of your head, like
From 2004 to 2024.
basically the last 20 years, what was the worst year? And it was the worst year was a minus 6% and change.
2017.
Close, 2019.
Okay.
So basically, and that was on the back of 3 or 4 years after the Royal Commission of the banking sector, and there was a range of other things that happened there. Ironically, then the best year was 2021, where prices increased 24%. Now, that 6% average annual growth takes into account all those lumpy times and good and bad times. But let's assume let's assume there is no spike in this 10% growth or 20% growth as these interest rates come down. By not doing anything and not taking that action, even if you get the average of 6%, over 5 years, that's 35% capital growth compounded in that time. Now, a $500,000 asset, all of a sudden, you've lost out in 5 years of 150 grand's growth, 180 grand's growth.
Just by not being there.
Just by not being there.
And again, to your point, this is not assuming yield or cash flow. This is just talking about the inherent value of the property.
And this just comes back down to what is the cost of doing nothing.
Yeah.
And
the mindset thing therefore is really important, because why, and the thesis is for every 1% you get 10 plus percent, right? Yep. For the time it takes to get there. Why does that take place? And a lot of people say it's sentiment driven rather than, well, a big part of it is sentiment driven rather than the actual machinations of people's ability to change their family budget to manufacture these. Oh, absolutely. People just go, oh, it's coming down, life's getting easier.
Yeah.
And this is this nascent inflection point.
Philip.
Yeah, it's a very good.
Nice one.
Where's that come from? but these, like, talk about flashpoints, inflection points, right? And for most people, like you talk about, for every $1 million, it's 2,500. We worked out as $200 a fortnight.
Yeah. Still not positive on that.
Actually, we've just got to make sure of that. 2,500 divided by 52 is.
Can we cut to some elevator music in
$50
that?
$50 a week is $100 a fortnight.
There you go, $100 a fortnight.
Yeah, $50 a week, right?
Yeah.
Let's say $50 a week. For every $1 million you've got in debt, you're going to have another $50 a week in your pocket. Now, that ain't got to change too much for most people. If you're redlining as a property investor at $50 a week, you probably shouldn't be investing in property like that. That's a pretty generic and basic. But you know, if that's all the fat you got, like, you know, so the real shift is a mindset shift.
Yep.
So people go, life's getting easier. I feel better about my finances. I feel like it's going to get better rather than worse. So therefore, I'm not squirreling away money or not making decisions because I'm unsure about what the future. So it's going to empower decision making and give more continuity to that decision making moving forward. So mindset is probably, and if you can map this out, will be the biggest change immediately after interest rate. Life's getting better.
Yeah. Especially when you couple it to some of the Goldilocks situations that we're kind of almost in, which is unemployment hasn't really oscillated or spiked where some of the fear might have been during this cycle. Now, like you said a little bit earlier that there's a lot of employment that's being spurred on by government. Yeah. Now, does that change after the election? Maybe. It will change at some stage, but it's not immediate, right? Like, it's not like a GFC moment or a COVID moment where the next month the lights turn off. It's going to be incremental. There'll be decisions.
Well, you'd be surprised. You know, if you get a new government, they'll look. You know, who are more market orientated rather than big government orientated. Like, you can turn the taps off pretty quickly.
Seems like you're assuming an outcome of this election already.
Well, have you seen the sports bets numbers recently? They've got the coalition like at $1.30 or $1.40.
The interest rate cut might help the
maybe. But look how quickly. And I always said it through the COVID period. Wasn't it refreshing how fast a government can move when it needs to move fast?
Oh, yeah.
Like, and look, there's a lot of discussions and the ramifications of the stimulus they put into it were playing out, like it's cause and effect, right? But look how quickly they moved but when they had the big bad wolf at the door, right? They moved pretty quickly. You've seen Trump come into his presidency a few weeks ago. He signed like, I don't know, umpteen numbers of executive orders. Yep. Look how quickly he's gone. Let me look at the foreign aid budget.
Yep.
I'm pausing foreign aid for 90 days until I work out what's going on. It just turned off immediately. And he'll make changes, right? When he's looking at sort of, you know, fundings for programs in Guatemala going, why are we doing this, right? Like, so if you do get a change in government, I think that will be decisive in steering the government away from big government and stimulating sectors where the taxpayers pay for stuff to being a market-led, SME-driven economy, empowering small business owners and medium business owners. So you will get change quickly. I don't think it's going to take a long time to play out. They'll go,
not necessarily.
This. We've got to get the economy moving. So, but again, it's a mindset thing, right? It's what are you going to do about it? You're going to do nothing about it. You can only react and respond to it as a property investor.
And then take that into consideration. What I said probably 5 minutes ago is, well, over the last 20 years between 2024 and 2004 and 2024. How many changes of government have we had? Not changes of Prime Minister, but changes of government to 2024. So the last 20 years.
Howard, Rudd, Gillard, Rudd, Abbott, Turnbull, Morrison, Albanese, APMs.
And how many of those on each side of the ledger? About 50-50. That was about 70 or 60-40.
In terms of
Liberal coalition.
Yeah, so you had
Labor.
Coalition, Labor. And I'm going to call that one, right? They couldn't work their stuff out.
Yeah.
Then you had 3 Liberal PMs, but they couldn't work their stuff out. Like, Abbott could have potentially been in there for the whole time, but so there was a bit of mix-up. And then you've got Rudd, and at least you've had stability under the Rudd government, because I think both political parties went, let's stop doing that stuff anymore. So I think we've got some stability back in the game.
But I guess my point here is that you sort of share power almost the entire way.
It's nearly 50-50. Yeah.
And in that time, go back to the average capital growth, it averaged 6%.
Yeah.
So
the government has no bearing on really long term.
If you play long term and you buy correctly, then you can sit there and think, put your tinfoil hat on and essentially freak out about every single movement that's going to happen about this, that, and whatever. If you're in and you can afford to stay in, and you do stay in for 20 years, expect that outcome. 20 years ain't that long as a property investor. Sadly enough, you and I are testament to buying, thinking that we were only really early into it. We're kind of now pretty seasoned in our space, and we've seen a lot. there's a fair bit of Salt Bay going on these days, and you kind of look at it now and you become so benign to property in the sense of the day-to-day movements or even the monthly or annual movements, that you just realise I bought and I kind of continue to buy and I haven't really sold. Yeah, I look back and I've done well.
If I didn't work in and around property and I was a property investor, I wouldn't look at it. Oh, you know what? The inverse, I'd probably look at it more because you probably want to know.
Because you actually want to know. But now every other day you're getting data and it kind of just you would subconsciously know more or less what's happening.
But
around
I say it, and I get fatigued talking about it sometimes. Because and the reason why is exactly the reason why you said, because you know what, like
it doesn't matter.
It's going to get all of this noise coming down. Like what's going to happen? Interest rate's going to go up or down. Like it's great to get stuck in and talk about it. But it really doesn't matter.
No,
interest rate's going to go up and down. The cost to hold your property is going to go up or down. Your happiness with being a property investor is going to go up or down. Your frustrations with being a property investor is going to go up or down. And the whole thing is that two key things, really, really simple. If you want to back property, you want to be back in property, which you're going to get that average, or you want to try and get beyond the average, and that's where I think most buyers' agents operate. It's like how do you win on 6% over? And the second thing is that there's going to be a lot of crap coming downstream you can't do anything about. So you've got to be able to hold on to your properties because that's the only way you can realise long-term compounding capital growth is actually if you hold the assets. So when your property manager calls up and goes, Paul, you've only got a single flush toilet system. You need to put a dual flush toilet system. You've got to sit there and just go, you got to sit there and just go, oh, I've got to fix that. But if you're a good property investor, you go, I know at Bunnings I can buy a new Dunny cistern for $69 and I can either jimmy it myself, but I'm not allowed to because I'm not a licensed plumber, or I'm going to have to pay a couple $100 for a plumber to do it. So you're in for about $350 to get your dual flush toilet. Now, if you can't afford that you probably shouldn't be investing in property. And this is about holding because you're going to get this stuff.
Absolutely. You're going to get it.
Someone going, you can't put your rent up more than 20% because of this, that, and the other.
What's your default always like revert back to old Mabs, sort of 85-year-old just sitting there, complaining on the phone.
Do that.
You can't do that.
Yeah. Who else would it be?
Well, I don't know.
Do you know big Guido Hatzis?
I don't think Guido would be arguing that way.
I don't think Guido would be allowed on the air these days. I saw someone Guido-esque the other day.
I'll spink you to the side of the head.
Yeah. Guido Hatzis. Mate, get him on for a podcast.
Oh,
have you seen There's a guy around social media in real estate called he's a Greek. It's like does a Greek parody guy.
Oh, my cousin Vlad.
My cousin Vlad. We need to get him on.
I reckon my cousin Vlad might be a chance. I reckon we both know a bloke who would get him on here.
Mate, I reckon.
Sunglasses and all.
Yeah.
Yep.
I reckon, mate, my cousin Vlad on the Smart Property Investment Show would be really, really good.
Let's do that. And get him and your mate Tom Panos on at the same time because
okay.
I've got a sneaking suspicion they might know each other.
Do you reckon it's the same person?
I don't think so. I think that's going to be one of those.
Is that Tom's avatar?
You just have to cut to one or the other. There's never ever dual screen going on.
He's like he's the modern day. He's the Guido Hatsis of property, mate. I'd love to have him on. He'd be brilliant.
He was in property.
He was
my cousin Vlad. Hence why he actually has a very good opinion of
he
property.
Knows it well.
He does know it well.
But and he knows the value of a good asset. He knows the difference between a XD Ford and a fully
Tirana,
sick
SLR 5,000 rather.
Yeah, there you go. But we digress. But the point is that you got to hold the property long term to get the benefits, and don't get too consumed to stifle your decision making and negatively impact your mindset.
Yeah,
because of all the stuff that you hear. And look, we probably propagate it. We've been talking now for 40 minutes on, hey, there's going to be an interest rate cut. What does it mean? Well,
it means a lot, and it basically means nothing at the same time.
It only means something. Here's the point, and you can talk to this. It only means something if you do something about it.
Yeah.
It has no consequence for you at all if you don't do anything about it.
Yeah, good or bad.
Good or bad.
bad.
So for a property investor, an interest rate cut is only as good as what you choose to do with the fact there's been an interest rate cut.
Yeah.
And you would be saying, well, what a time to actually consider whether or not this can fast track your portfolio or change how the assets you're buying in your portfolio, or it's going to shape your strategy. Yeah. And that's the proactive part of it. That's why you need to talk to someone and get advice.
Massively. And if I probably add a little bit more sauce to that sizzle, where I've found over the years when interest rates push up, the desire and all the talk and the fanfare pushes more towards yield because people think, well, I've got to be able to afford to hold this property a bit easier, so I've got to find markets that give me more cash flow. When prices come down, and anyone who was buying property in 2020, 2021, you would have probably known firsthand that you could have bought a blue chip property in the best markets of Sydney, Melbourne, Brisbane, Adelaide, Perth, wherever, with a yield of 3%, and it would have been neutral with 100% gearing. Now, obviously,
them's were the days.
Them's were the days, but people were comfortable doing it because the ramifications from a cash flow meant a lot less. People talking about, I need to get a 5, 6, 7% gross yield on my resi property to really make me confident in making this decision. It was irrelevant because you still weren't buying to buy an income or for cash flow. You were buying for growth, but you knew you could hold a larger asset in value because rates were cheaper. Where I'm getting to is that we've gone through a couple of years of higher interest rates, higher cost of living, higher expenses, higher everything. We will start to see that will dissipate over this cycle. Now, the conversation then switches and start to think, people need to start then switching their mind to which markets go out of favour when prices essentially price of money goes up. Well, you typically find that it's your major markets with higher median average prices are the ones that have been out of favour. Lo and behold, you look at the last month's CoreLogic data for January 2025, Sydney went into its second consecutive month of declining value. Melbourne is about 3% off where it was over the last 12 months. It's flat, if not still slightly backwards. Those markets have been out of favour, particularly Melbourne. But they've actually had no issues with regards to vacancy rates. Melbourne in particular, and broader Melbourne, Geelong, Ballarat, Bendigo, etc., they've actually seen strong, circa 6 to 8% rental increases as a percentage over that last 12 months. So the actual rents are going up.
Yeah, but how much of that is because you've got less investors in the market?
Well, I think quite a bit. But that being said, your yields in some markets are 4.5%, 5%, which is kind of unheard of for that market.
Based on purchase price?
Based on purchase price. Based on purchase price. Yeah. But if you look at
current purchase
price, so current market value.
Yeah.
But I mean, you look at the last 20 years and you go back through the historical gross rental yield for Melbourne as an example for a residential house, this is about as high as it's been. Now, when prices of cash come down, holding that property. I mean, I personally have balked at buying property in Melbourne a decade ago because I looked at it, I'm like, you know what, I just don't love where it sits from an overall holding perspective when I can find better value elsewhere. That value elsewhere might have been Brisbane at the time, might have been Adelaide, might have even been Perth more recent years. But you know what? Those markets have all gone well and truly beyond where they were.
Yeah, and this brings us something pretty important. So Smart Property Investment and Pure Property teaming up again for the
Fast
50 2026. So where to put your money today for the best capital growth in 2026. This is the third year we've done a report. We've debriefed on previous reports. We've scored us pretty well. We've largely got it right. So that body of work is happening now in the background. It's going to be expanded out a lot more for this year. There's more experts coming in. You know, we're drawing a little bit more on pure property to get some greater science and insights into how it all works. But I think this report is going to be a lot harder than previous reports because, you know, every state is very different now, and the reason why I talk about Melbourne. Melbourne doesn't look right at the moment. Like it's not normal. So when there's stuff's not normal, you interrogate it, right? And I think, I don't want to telegraph stuff because I haven't seen anything yet coming out of the research team, but I reckon you're going to get a few Melbourne suburbs on the report this year.
I think you might.
Yeah, and then you look at Sydney. And you spoke about Sydney markets, 2 consecutive months of decline in property prices. And you look at Channel 7 or Channel 9 on telly and they're telling you there's, prices are coming down and isn't that great? That prices, I don't know how many homeowners in Sydney are happy that prices are going down. People who are looking to enter the market are happy, right? So this is, again, there's two sides of the ledger. You've got first-home buyers and owners. But then you've got Brizzy. And Brizzy, you've had a slowing of rental growth over some time. And you've probably now had 18 months of a preparation of that market shifting from being good place to buy to I want to make sure that I can cover the cost of holding my investment there higher for a period of years of higher interest rates when stuff started going up to softer rental growth now. And you're seeing now creeping in, vacancy rates are increasing, costs is increasing, prices are coming down. Have you seen this price coming down a little bit in rents there? So it's already sort of pricing in a market change, right?
Yeah, absolutely.
So I reckon you're going to have a lot less Brizzy suburbs.
I don't disagree.
On
and I also don't just lump it into Brizzy. I'd probably say Southeast Queensland, even regional Queensland. I start to see now, you look at markets like Bundaberg, Townsville, Mackay. These markets had historically...
Shout out to our friends up in Townsville at the moment as well. They're doing it tough up there.
Thankfully, that all sort of started to... All the warnings have passed now. But, it's been a tough week and a half, tough 2 weeks. And that this won't help necessarily in the sense that it's a tight rental market, and when people are displaced, obviously that makes it even harder, and it will have an impact there, which it has in many markets over the years when you do have these natural disaster events. But I guess where I was getting to is that you look at the yields of these places, historically they've been 6, 7, 8% markets. Now they're more like 4.5 to 5.5% markets. And then you start to think, well, okay, if rents are starting to come down, not necessarily go backwards, but asking rents are starting to moderate more into that line of where CPI inflation is, and you're starting to see now that the actual cost of buying a property hypothetically in regional far north Queensland versus maybe somewhere in the outskirts of Melbourne, and you're spending $500,000 and you're like, I can get the same yield on a property within a 6 million population market versus a regional market of 150, 200,000 people. And I'm seeing a market that hasn't really done anything over the last 6 or 7 years, but historically over the last 50 years has been the number one performing capital city. You start to ask questions. Now, you mentioned that Fast 50 report. I think this coming 12 months, we're not going to see, we predicted not just last year, but the year before that there was going to be multiple markets across Perth. And I can think of almost, I think we went through this. Out of the top 10 suburbs that grew the most in value in last year, out of 10,000 plus suburbs in Australia, we picked the top 9. So that, for me, whilst that's not an easy thing to do, the data was a lot more obvious. This coming year and the next couple of years, it's certainly going to be more varied. Perth's slowing. Adelaide and Brisbane will continue to slow. Melbourne's looking valuable, but does that translate to 10, 15% growth in the next 12 months? Maybe not. But, you've got to position yourself for a 5 to 7 year. And what this data also says, think about 20 years as well. Think about how it reverts back to the mean.
Yeah, so I look forward to navigating the Fast 50. So that body work's underway, and the report will be coming out soon. And there's a whole bunch of people involved. It's really interesting because you've got the cream of property investment experts in Australia contribute to that. So it's good to be able to team up with Pure Property again to deliver that. But what does all this mean? What do you do about it? What's the actions after listening to this podcast? Well, we're assuming a rate cut in a couple of days' time. And all indicators would say, like this, as I said, I've still got 20% of me where they go, oh, there's fringes there, but maybe they'll, you might get a cut and there might not be anything for a while. I think a lot of the economists are still, these are still the same economists that were pricing a 40% decrease in property prices 5 years ago, by the way. I'll just mention that. However,
they are one and the same. And they're also the same people that were predicting a 10%, just north of 10% unemployment rate at somewhere between the 18 and 24 month cycle into COVID as well. These are the same people.
Yeah. So I think what we're talking about now is maybe easier to forecast, because you haven't got those seismic external forces out there. So I don't want to give economists a hard time. I think they do a great job. But so we're assuming that there's an interest rate cut, and I'm assuming that we're going to have great fun, the merry dance, to see which lender passes on rates fastest, if not at all. So prepare and strap yourself in, people, for potentially refinancing. And what you'll see is really an inside view of how banks operate. And if they don't want to grow their mortgage book, they're not going to be passing on any interest rates.
That's it.
For those lenders who are looking to aggressively grow through this period, you're going to see some sharp pricing from them. They'll either move quickly.
And they'll have their marketing ready to go right now.
I know all the lenders are set and ready to go. They're probably all eyeballing each other. Probably already, lenders don't collude, but I'm sure they're sitting there going, "Oh, I wonder what they're going to do. Who's going to move first? Should we be first, or should we wait?
Go before the call?
Yeah.
Should we go
before the call? There's a lot of guerrilla type stuff going on. So be ready. Get yourself set for
$2,500 for every $1 million you got exposed.
Yeah,
I mean, this is it. $2,500, 6% per year you miss out on by not being exposed.
Yeah.
I mean, these are the numbers. Just if you take anything from this conversation, they're the numbers.
So do you need to speak to your broker first to work all this out before you speak to a buyer's agent? Or do you speak to a buyer's agent and get a sense for what you can do and then really bring in a broker?
Either or.
Yeah.
I mean, look, I certainly wouldn't advocate buying a property unconditionally without having that. Obviously, you're putting pen to paper on a contract even until you've got the word from your broker that your ability to borrow X amount, whatever you're buying. Even if it's just indicative approval. I mean, we would never buy unconditionally anyway. So if I was to say, hey, you're signing a contract of sale here, it's still going to be subject to finance. And I would say subject to probably 21-day finance. So yes, you might be in line to lose a holding deposit, but I certainly would want to work through people's numbers before we even got to that point to say, look, I can see that you've got buffers in place, you've got equity available, your borrowing capacity will allow for that type of purchase, and long term it means we can push forward with this type of property. So that's part of that strategy, and that might then lead to saying, let's have a conversation with a broker to then get that moving. Or conversely, you might already had that conversation and you might say, I know I can probably get somewhere around about this number. Our job is to probably take that number and then massage it to say, here's the markets that'll fit the higher end of that number, here's the markets that'll fit the lower end of that number, and here's what we should be doing, here's how much cash you'd need up front, and a range of other things that go with that. And that also then starts to forecast what happens over the next midterm, so 2 to 10 years, what happens over long term, say circa 20 to 30 years, start to model all of that out as part of that process as well.
Okay, so it's an interconnected chat with...
Massively.
Yeah, and the best investors know that property's a game of finance. So you control your finance, you control the finance, you can control the tactics, you control the maneuvers. So
first you get the money.
You need the money. A lot of people, it depends, again, it's a mindset thing, and I think about myself, I have no shortage of equity, and I sit there going, do I really need more property? But then I go, so if I take on more debt, that means I've got more cash flow to consider. That's okay. But when is enough and blah, 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 blah. But, if it's going to be a good time to be buying, well, why wouldn't I want to sort of... You
love a bargain.
Get in the game. I like a discount.
Yeah,
a heavy discount.
Discount.
I'm considering, I do, to your point, the capital city in Australia, which has shown the best long-term integrity of property prices or property price growth is Melbourne.
Correct.
And Melbourne is or nearly is or will be
the biggest,
bigger than Sydney.
Yep.
By some margin moving forward. It will be the biggest
looks
city.
likely that way.
Yeah, the biggest city in Australia. Purely, a lot of it driven by geography, right? It's just the way it is. Yes, you'll get some infill and stuff. So, I am in Melbourne, but I'm not. I don't have a lot of exposure down there. So I'd really like to sort of elevate that. But that's the sort of discussions you need to have, right? You know, so no doubt you're right. If someone just calls up going, "Oh, that's what I'm thinking." What do you reckon?
Absolutely.
Is that what you guys do?
I'm happy to align or adjust the thinking where my personal preferences and our data is going to.
So, are you buying in Melbourne now?
Yes.
Okay. You're not going to tell me where?
Depends how much cash you got.
So if I jump on a Virgin, because most buyers agents or property strategists fly Virgin for some reason. Like if I sat on a plane, have they actually like they've done with
Are they landing at Tullamarine or are they landing at Avalon?
Well, I know that Qantas had to put on some new flights to Perth just for all the buyers agents to head out there.
Thankfully, we're sort of walking the other way.
You alone have increased prices to Perth.
Mate.
It's impossible to get a
We did a
flight
lot of
there.
flying there in 2020, 2021. 2019, actually, we were doing a lot more flying there, to be honest with you.
So you're not flying to Perth no more?
I shan't be doing much flights to Perth.
Okay.
No. Lovely place. Still love it.
So and most of the flights you're taking now to Melbourne?
There's less kilometres, yes, on frequent flyers these days.
And is every single buyer's agent now on the Sydney Melbourne flight?
See, I don't want to propose that I influence markets or pure property influences markets, but over the years it seems to have done a little bit of that. But I would say that from what I've heard and seen out there in the ecosystem, that there is certainly more people moving that way now. That said, that I don't propose that if you're buying a property in Melbourne today, in the average price, the average property in the average market of Melbourne, in 12 months' time, you're going to look at it and say it was the best performing market over the last 12 months. Mm-hmm. It's probably still quite unlikely.
So you don't need to rush into things because I remember 2019, early 2020, when a handful of people I was chatting to, you included, and some other blokes. Or some other very reputable buyers agents, and I think of guys like the crew out at Momentum Wealth who were at Perth base, pretty much saying, it's early.
Yeah, it's early.
It's early, but a handful of people knew the smart money. So what's the worst thing that can happen if you enter a market early?
Yeah.
What's the worst that can happen? Well, your money didn't work as hard.
But could it have done more elsewhere for a shorter period of time? Well, you're not going to buy in. Hypothetically, you're not going to buy in Adelaide in 2025 with the intention of selling it in 2026 to take the profit and then reinvest in Melbourne. You're still not going to do that same thing and not sell but take equity because there's not going to be enough. Regardless, it's just not going to be that same proposition. So when it comes down to it, Phil, like we talked about it in 2014, 15, 16, you bought a bit of property in Brisbane in that time and you sat here for 3 or 4 years moaning and groaning and beloaning. It was early.
Well, it was so early that most people I knew who invested at the same time early. And I think you were the same.
Yeah.
You bought in Brizzy, noting it was early-ish in the cycle.
Yeah. But it was still cheap.
It just wasn't early. It might not be at all.
Yeah.
But then it went...
and here we are, 150% above where we were in 2014.
So Melbourne won't do what Perth's done over the last period of time. You're not going to get these 20-25%.
I highly doubt it. No. I highly doubt it.
Just structurally very different.
But will it see above average, i.e. above 6% average long-term compounded growth? I wouldn't be surprised in the next 5 years you'll see a few breakout years.
It's got a big catch-up, right?
Massively.
And
it's not just catch-up.
Normalising.
Yeah, and it's not just catch-up. It's value. People will have the ability and can pay more. And there is a shortage, not just in Melbourne. There is still a national shortage of property, and we are nowhere near
for investors
for accommodation for the demand that sits there. We are still miles behind our target of the national target that the government set. We're looking about 30% below that if we hit every single number that we can possibly hit. It's
so
just
dynamically,
not going to happen.
So we're already behind the 8 ball, and if that extrapolates out, we're going to be way behind.
Way behind. And even if we start to see if a new government comes in and they start tinkering with overseas migration, is that going to then impact the demand? Well, it will, but we're still miles behind. Even if we track back towards long-term averages as far as immigration, overseas immigration, is international and domestic migration is concerned, we are still going to be behind for the foreseeable future. So is there a structural issue if things change? Well, I just don't see where and how that can happen. If money gets cheaper, there's going to be more demand.
It's going to be hard. It's, the immediacy, it's hard to move the needle considering the complications of developing property right now. Like, you're talking years and years and years. And even if you get a change in government and there is intent for them to actually change the way in which stuff's developed, it's going to take time. Like that's trying to turn a ship. There's too many moving parts. Nothing's going to happen quickly.
This is it. And I'll give you an anecdotal example here of this, Phil. And when I talk about how hard it is, we talked about a development that I'm personally doing up the north coast of New South Wales, personally, a 20-odd lot subdivision, and I'm building 22-odd properties on this subdivision. I've got to the point now where I've had to go through and talk to a lot of large-scale house land package providers to figure out how to get this development done at a price that I know is going to be hitting the market at a price that I can actually sell these properties at a profit at all. And this goes to the larger scales of, and I'm not going to name names, but the larger scale project home builders. If I look through numbers, where I've now come back to is I'm actually gone to a company based in the Newcastle region to look at options of, can I actually build these properties as a modular home, put them on the back of a truck, put them back together on site to actually come in at cost of a price that I know is actually going to have any profit at all. Because the reality when I look at a $700,000, $800,000, $900,000 property in markets like Ballina, Gunnellabar, Lismore as an example, and for some people might not be for me, but it doesn't take much to go on realestate.com and look at what prices in those markets are for a brand new house and land. To build a 4-bed, 2-bath, 2-car garage house works out pretty much across the country right now at anywhere between $2,500 to $3,500 a square metre at the entry level. And if you put that in perspective, for a 200 square metre house, which is a pretty standard 4-bed, 2-bath, 2-car garage house, you're talking $450 to $550, absolute bare bones entry level for minimal landscaping, some fences, and building that house.
Plus the land?
Add on your land.
Add on the land.
So you start to reverse engineer this, and stamp duty, and you've got all of your cash costs, all of your GST, all of these other things that go with that. You start to realize that to build property is a very hard way to make money. And my point with this is that you are just not going to see that much property developed because the value and the margins aren't going to increase anytime soon.
And to the point around, the speed at which we're building housing in Australia is inhibiting our ability,
the red tape
to propel the nation, right? Like this is why they're going down a pathway of taxation incentives and stuff for
they got to
build to lease,
right? Which
in America, or if you've ever been to Europe,
it's a norm.
It's normal for like a lot of rental accommodation is owned by conglomerates.
Yeah,
a lot of rental accommodation is owned by the state.
Yeah, the equivalent of our super funds.
A building of 200 apartments is owned by the rail company.
Yeah, and they're doing it cash. They wipe out a huge need for a lot of the time, a lot of need for credit and all those costs that come with it. But this is the problem. And we've talked about this before in a couple of episodes before as well. Is that we're talking about all this rezoning, particularly in Sydney right now. You're changing density from R2 to R3, R3 to R4 to go from 4 stories to 8 stories, etc. It doesn't really help. It doesn't help. And this is.
How do you? And I'll conclude with this.
Yeah.
Then how do you? How do you process that? Because people go, I want you to find me a property that's got all upside.
Yeah.
And you go, oh, you want to buy this upside, do you? So you want to buy this on the pretense that you can develop on this at some point in time. So therefore, this same property, let's think of a place in suburban western suburbs. Let's choose Toongabbie, for example, right? On the rail line.
Yep.
It's probably a bit, let's choose Wenny because Wennerville, because you actually get a faster train in the city, right? You go, this property here and this property here, right next to each other. One's inside of a zoning envelope where you can go up to 20 stories. This one next door is in a zoning envelope where you can put a duplex on it.
Yep.
This one here, you got to pay a premium of it 2 times, 3 times, whatever the price is, on the basis that can be developed at some point in time.
Yep.
So some people go, oh, that's a great strategy. Find me something with next factor, Simon the upsides. Like, in order to realise the upside, there needs to be market conditions that facilitates upside potential. So most people aren't going to develop that themselves.
Yeah.
And developers might not want it when you're ready to sell it, thinking it, because it's just impossible to build on it.
Well,
right?
this is
because
it.
things change. Things change. Like buying properties for upside potential can sometimes put blinkers on investors and they get absorbed and obsessed by it, when often you're better off just going, you know what, let me just buy 6 point something% growth, compounding with no headaches, no issues, no nothing. Just get on with it. That's most probably.
Meat and
How
potatoes.
do you balance that?
Meat and potatoes. And you have to draw on your experience. And that is, your example there is prime, because I get that, obviously, that question a lot, and also that demand a lot. But you do have to temper the expectations to say, well, personally speaking, I mean, I've been involved in over 3,000 transactions, and that's over 6 different states and territories across Australia over 12 years. In that time, I've seen properties go from R2 zoning, or essentially low density residential, to high density multi-story opportunities. I've seen what happens to the value of the property, but does that actually move the needle for the owner at all? Well, no. It's highly, highly unlikely that someone who's bought a $500,000 property that maybe is now valued at $1 million is then all of a sudden going to go and build 20 apartments. You just don't understand how much money, time and effort and expertise would be needed to actually do that. Now, the value uplift, yeah, great, you got that. But would you get that same uplift by buying a 422 on a 600 square metre block in a market that is going to be undersupplied, that is already in a position for prime growth? Absolutely. And for me, the time, effort and hassle that goes into it, if I had my time again, Phil, and I reckon you'd say the same thing. If someone came to me and said, Paul, I went to someone rather and said, I want you to build me a strategy and I want to buy 5 properties over a period of time to build my long-term value in assets, I would completely and utterly want to align myself to 3 or 4 bedroom, ideally on anywhere between a 350 to 800 square metre block of land, depending on the market that it's in, and as minimal maintenance as possible. It doesn't need to be brand new, but I don't want it to be something that's a renovation project or something that is completely dilapidated, and I want it to be in a market that's relatively infilled. That is it. I don't want it to be anything more remote. I don't want to see some random zoning. I don't want to see some train line that might go in 4 to 6 years, or some airport that's going to then all of a sudden change. I don't care for that. What I care for is, how is this going to get influenced over the next 10, 15, 20 years? And the retrospective data shows that every single time you buy simple.
Buy the growth. And simplicity keen. And to that point, and I just want your view on this because we're talking about it. So we talk about those 2 properties, exactly the same area, different zoning, right?
Yeah.
Purchase price of one is, say, double.
Yeah.
I'm being really simple, because it has development appeal.
Yeah.
Like that. So that there's some opportunity at some point in time to get a different utility out of it versus something else. If you buy the one with development appeal versus the other one where you can just bank on 6% for simple numbers, compound annual growth, does the one with development appeal that you paid twice for grow faster than the one next door that doesn't have development appeal, or will they grow at the same rate? You know what I mean? So, like, are you buying?
And we've got thousands of people listening to this, and I reckon you'll get some of them will say, well, that's BS because I bought this property and it did this, or that's BS because I bought this property and it did that.
No, I'm assuming you do nothing.
I know.
Yeah,
I know. I'm talking about when I say
it
did this from a growth standpoint.
Yeah.
From my experience, the price is already factoring in the upside. So if you're paying double, the person selling it has already done the math on saying, well, if a developer bought this, they can build X. To build X, they need to build it at this and they'll sell for that. So if I work backwards, here's how I come to that number anyway. So if you're paying more up to a point where there's a margin in it anyway. So will that see more growth? Unless the zoning goes from X to Y even further, there is not going to be any further upside for you. Zoning changes do definitely help the value growth, but you're all of a sudden tossing coins up in the air and gambling. Yeah. For me, that's the part. Unless you've got absolute gazetted inside information of a zoning change that's imminent, which you shouldn't have, and you also shouldn't ever invest on. For me, the price is already baked in.
Yeah.
So the growth will come from future market growth. The price that you're paying today is already factoring in all that upside anyway.
Yeah. So it's just a more expensive property.
It's a more expensive property with bigger outgoings, less cash flow.
So you're better off going, maybe I'll just buy the one next door. I'll bank my 6.5 and buy another one where else, hopefully get 7.
That's it.
All right.
Yep.
This is all the complications of property investing is why you probably need a buyer's agent. How do you get in contact with you guys?
1300 985428, purepropertyinvestment.com. I know we're actually, where is it? No, that's it. I was going to say Instagram, Facebook, all the normal stuff there. But we've actually also just got our audio book. So if you
an audio book.
If you don't want to,
look, there it is.
Bam.
Service guide. But did you put that there?
No.
Yeah. I'd rather.
If you want to, if you don't want to read it, obviously I did place that quite nicely. If you don't want to read it, then you can go and download the audiobook. Audiobook's up and running on the website. So we are actually live, ready to go. That's a bit perverse. Expect that from you.
There we go.
But yeah, purepropertyinvestment.com.
Was it Love and Addiction? Looks a bit
There's
better
a few interesting ones on there.
Yeah,
the Brave Toolkit.
Yeah.
Tuberculosis.
How I built this. Is there tuberculosis in there? Anyway, yeah.
But yes, purepropertyinvestment.com.
All right, there you go, purepropertyinvestment.com. Thanks for coming in, Paul. All very good. There you go. Perfect. Who would have thought? Who would have thought? Thanks for tuning in, everyone. That's the Pure Property podcast with Paul Glossop, and he's got his book there, The Surfer's Guide to Property Investing, The Next Wave. You've been getting out of it, by the way?
I have, mate. Actually, summer's been good for me.
Oh, cool.
Yeah, definitely got plenty of waves, caught plenty of fish. Good times.
Why don't you do the Fisherman's Guide to Property Investing? There's probably a lot more analogies in that.
There's a few, but then I have to draw on my poor experience of fishing. Where I'm a fisherman, I'm not a catchman.
A catchman. Mate, I hear there's a lot of yakkers out there.
There's no shortage of yakkers. Unfortunately, yakkers don't feed my family. They typically can feed large kingfish, but I've still...
Slimy or yakka?
Slimies.
You prefer a slimy?
Slimies you can get your hands on little slimies, but I've been getting a lot of slimies lately, but a bit too large unless you're going out for the billfish. Yeah. Plenty of billfish around the Sydney markets at the moment.
Oh, okay.
Yeah.
There you go.
Close in too for those
Close
who
in.
are...
There you know.
Yeah, Jan, Feb,
I know a guy.
weather.
We know a guy that just bought a boat.
Oh, we do?
Yes.
We do.
Yeah.
We do. Botox.
Is that what he called it?
Botox.
God. Really?
He's got a Botox appointment.
So we've got a Botox appointment.
Yeah.
Anyway.
Each their own.
Thanks for tuning in, everyone. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.